Hi, I'm Brit Wittman here with Workspan TV, and I have with me today Mike Halloran. We're going to talk about how to think about pay-for-performance alignment in today's environment. So, Mike, give us a little background on pay-for-performance alignment. Where do you see it today, and where do you see it going in the future?
We actually have two things going on in today's world. One, we have incredible short-term pressure for results. Analysts asking every quarter how you're doing, investors looking at the same thing. Yet management teams trying to drive themselves towards sustained long-term performance. And you've got this disconnect between how can you invest for the long term, which might mean some ups and downs quarterly, but nevertheless, if you do have too many ups or downs, you take significant hits in your stock price and the like, and it's a very difficult balance. We also have the issue of when you get into compensation and pay for performance for senior people. You got the issue of long-term alignment. Nevertheless, you have outside groups using scorecards are looking at best 1 and 3 year TSR, so heavy emphasis on short-term performance nonetheless. With all of this kind of mixed messages around, most companies are trying to stay a course, which is what's our business strategy? How do we best measure success for that? And then let's pay for that. We assume if we achieve those strategies, our stock price will follow and investors will be happy, but you have to be willing to accept bumps along the way just because of all the different forces at work.
How are we defining success from the shareholder point of view? Is the TSR seems to be on the rise? Everybody is focusing on TSR, and as you said, in 1 and 3 year increments. Is that going to be our metric of the future, or is there a way to balance TSR with other approaches to measuring performance?
Most feel it's a slippery slope to fall into the path of it's only about TSR. You get into the issue of how do you really get line of sight for senior people. You can't walk in the morning and say, how do I make TSR better? That's not really a question that can be answered. You can answer questions about how do I grow the top line, how do I make savvy investments, how do we beat the competition, things like that. I think what we're going to find here is management teams and compensation committees looking to push back on this 1 and 3 year TSR alignment pressure and try to stay the course with key financial metrics that drive the needle. At the same time, we will see and have seen creeping into incentive programs, certainly on the long term, the use of relative TSR just because it's hard to tell your story and saying we've had great financial results and TSR has slipped. You need to have some balance in the system.
Yeah, I think balance is key, and balancing time frame I think has become a real issue. So you mentioned 1 and 3 year TSR. We know goal setting has become much more difficult, certainly on annual plans, and 3 year seems like long term, but when you're talking about stock price movement, is that enough time to actually measure performance? Balanced with the fact that we're seeing executives turnover in a much quicker time frame than that. I think CEO average turnover is happening in less than 3 years. So do you get the opportunity to focus on the long term truly in your long term plan?
It's another good observation. We clearly have seen a shift in the past 5 to 7 years where it used to be people would mention long term and think 3 to 5 years. It's impossible to do that these days. You've got macroeconomic events that are shaping things daily where you really, as you said, it's hard to set annual goals sometimes, much less 3 year goals. 5 year goals are out of the question. You can think, well, maybe we can measure ourselves against the competition over a 5 year period. Well, competition gets reshaped very quickly these days with M&A activity and the like, very hard to do. And investors in general seem to be a bit impatient. You talk about CEO turnover, that's also true at the executive ranks. The CEO turns, the team often turns. So all things being said, we're in a 1 and 3 year environment, but again, the focus of trying to have balance on what are the right financial objectives to have with perhaps some realities that TSR can't be overlooked is, I think, where we're heading.
You also mentioned relative versus absolute. You talking about relative TSR. Do you see both of those? Is there room for both of those measures? Is one more important than the other?
Well, I think if we focus on TSR, the only fair way to measure it is on a relative basis if you can. That assumes you've got a reasonably good set of peers against a benchmark. Setting absolute TSR numbers is very difficult, hard to know where that might be. And also you've got, again, macroeconomic events that can reshape that for you where you really can't control your destiny. On the flip side, though, I still think some balance meaningfully with long-term financial goals and short-term financial goals with some perhaps TSR in the picture makes sense. Many companies deliver a lot of compensation in stock. Doing that has built-in TSR into the equation. That being said, the doubling down on additional TSR measurement is something that needs to be done very thoughtfully, but clearly there's growing interest in doing that.
The time frames are very interesting in long term, and also having the stock align with TSR. I think that point's actually been lost a little bit with some of the downward pressure on stock options are not performance based, and relative TSR, some of the complaints are peer groups or even single companies springboarding off a low and then having on a relative basis great growth over short time frames. So is there a time period in which you can get away with having good operational performance and perhaps not good TSR, and how long does that story play out before you need to make a change?
Well, I think for the most part, your 3-year time period that you referenced earlier is probably in today's world reality. That you get a couple years to do your thing, make the changes you need to make and get the business going in the right direction, assuming you're there to fix things or to continue it on a steady path if you've taken over from what had been a good performing company before then. But we have a very restless investor community, a lot of critics, a lot of hedge funds and others that tend to jump in when they see results not heading in the right direction. So 3 years these days is a period which, if you haven't proven that you can do a good job, you're going to get a lot of attention otherwise.
So a lot of focus on say on pay and investors, and we tend to talk about the investor community kind as one entity, but it seems to me that there's sort of a fractured base there as well. As every company says they have an individual story, and to a large degree that's true. I think the investor community doesn't look at us all the same way. Is that your experience as well? Are there some that are willing to go longer time frames or understand the nuances of the business, or are they just simply using ISS and checklists to describe how we should be approaching executive pay?
It is a fractured investor community. The larger investment houses that have hundreds of billions, if not trillions of dollars to invest, have to be spread out, so they're invested in everything. And they need to stick with you unless it's a complete disaster, in which case they may even agitate for change. So that's one set of the population that probably has more patience.
Tell us a little bit about dealing with institutional investors. What are you seeing out there from different institutional investors and their requests with regard to pay and performance?
Well, they do fall into several categories. Some really don't have a high interest in talking to you unless they think there's a problem or you think there's a message you need to send. Their plates are pretty full. A lot of companies want to come knock on the door, and some are even asking why you need to talk to us. You're doing pretty good, we're happy, why do we need to have a conversation? In other cases, if you're a company that maybe has been struggling a bit, you probably need to get the message out. Say on Pay has been used almost as much to send a message that we're unhappy with management as it is with respect to how the company has been performing. So we're seeing that this ballot box approach does give people the only avenue to send a message, and it may not always be about pay. So getting out and talking to people sometimes can help you understand, is it about pay or is it about something else?
Yeah, I think that's been an interesting development on the say on pay front. Is it's sort of a chicken and the egg. Which comes first, the pay or the performance?
Right.
And in some cases, it truly is the pay conversation. In others, it's the performance.
And there are even some that ask the question: if no one has complained, do we still be proactive? Might we be raising a question in the minds of the investor? Is there something going on here that they perhaps haven't told us, but they're out in front of this? So, sometimes be careful what you ask for.
All right, let's turn to the future. What do you see happening with pay for performance going forward? Do you see the advent of binding say on pay? Do you see more shareholder activism? Do you see performance coming up in the markets and all of this goes away? Where do you think we'll be 5 years from now?
One, I would say no binding say on pay unless there's some big fiasco on the corporate side. The government tends to overreact when those things happen. That could be a way to go. Binding say on pay is coming on in Europe a bit, but we don't see that coming overseas yet. Next is the pay and performance side of things. I think the battleground has been set. Is it all about TSR or not? As we were saying early in the game, I think companies are going to realize that TSR is a high profile metric that's tracked by many, but they're still going to want to fight somewhat or push back against that pressure having to do with we need to sell our message regarding what we're really driving this company all about, and what we're driving it towards will lead to better shareholder return, but not necessarily going to be the only thing that what we're about. I think those are the two kind of battlefronts going forward.
Thanks very much.
Enjoyed it.
This has been Brit with Mike Halloran on WorkSpan TV. See you next time.